Michael Burry recently tweeted, "What strategy will pull us out of this real recession? What forces would pull us so? There are none. So we are really looking at an extended multi-year recession. Who is predicting this? There is none." Now we are seeing some experts saying that next year could be a lot of pain. Now, November was a year of optimism because investors deemed October's inflation numbers to be low enough for a less hawkish Federal Reserve. However, consumer prices in October were 7.7% on a year-over-year basis, down from 8.2% in September, and what looked to be a near-term peak of 9.1% in June. Minimizing price stability is one of the Fed's two main goals. Another one is maximum employment. And so cooling price growth means the central bank is more likely to back off on their hawkish policies aimed at reducing inflation. But 7.7% is still far above the Fed's stated long-term goal of 2% inflation. And Jerome Powell said that they are committed to getting there. However, some investors don't believe the Fed's promise of resolving their goal. For one, the Fed has already hiked interest rates at most aggressive pace since decades, and some believe that they have to wait and see how the economy responds as rate hikes work on a lag. Secondly, it may already be too late for that. Many forecasters see a recession ahead thanks to the monetary tightening that's already taken place, and a recession will leave the Fed with no choice but to ease policy again. Investors seem to run with the pivot narrative when Fed Chair Jerome Powell said in a speech at the Brookings Institute that the Fed would slow the pace of rate hikes. The S&P 500 jumped 3% on the comments. Despite that, markets have largely priced in hikes of 20 to 50 basis points going forward instead of the 75 basis point hikes that have occurred in the central bank's last 4 meetings. November's job reports, however, puts a pain in hopes of those anticipating easier policy sooner. The Bureau of Labor Statistics said that the U.S. economy added 236,000 jobs in November, which beat economists' expectations of 2,000. The unemployment rate stayed at a near 50-year low of 3.7%. This reading gives the Fed permission to forego ahead with their hawkish regime as the economy is showing its resiliency. Now, this is very bad news for stocks. Higher interest rates eventually weigh in on consumer demand, hurting corporate earnings. They also tend to create higher yields on government and corporate bonds, creating more competition for riskier stocks. The CIO of IRA Advisors says that he thinks the S&P 500 can rally to 4,100 to 4,200 by mid-January due to the end-of-year stock buybacks and retirement fund inflows at the start of next year. He does think that the index will then retest lows around 3,700. That's almost 9% downside from current levels. The CIO of Private Wealth Management at Glenmedate said, while the Fed may slow down its rate increases from 75 basis points to 50 basis points, it may also place pressure on them to extend those rates increases further. Moreover, hourly wages grew 0.6% in November, month-over-month, and 5.1% year-over-year. Wage growth helps fuel inflation as consumers have more income at their disposal. Wages have held surprisingly firm, and unfortunately this is a step back in that otherwise improving inflation story. This will be concerning to markets, and while we are on a better path than a few months ago, we are still not done yet. Policy will likely continue to be restrictive near term, and the more it stays restrictive, the more pressure on earnings next year. Moreover, the head of the U.S. equity quantitative strategy at Bank of America said that she expects stocks to have a rough start to 2023 amid a recession unfolding. Similarly, Goldman Sachs chief U.S. equity strategist said that the S&P 500 will remain flat through 2023 despite a base case soft landing outlook, and that the index would see a near-term decline to 3,600. So all the data does show that we are really looking into an extended multi-year recession. This is a really good time to have a plan for how you want to invest. we do see that the data for the inflation, it's actually getting better, which means it's really bad. There will definitely be pain ahead, and being prepared and having an idea for how you want to invest in this downturn and grab this opportunity of a lifetime. Planning is the most important at this point. This is a very rare and good opportunity to buy the stocks you've always wanted to at a discount. So I hope you liked this video and got some insights out of it, and I shall see you in the next one. Bye.